Hello and welcome to all of you in my channel Blue Chip Finance. In this video we are going to discuss about the project analysis part 2, which is the extension of part 1 of project analysis. So let's start the today's topic, and in this video we will discuss first of all question number 3, that an automobile company is going to invest in new type of lubricant which costs 12 million. So it is your initial cost to adopt. If you adopt this project, this 12 million is your initial cost, and when you invest in this project, expected life of this project is 6 years. Expected sales of automobile cans are 7 million cans. There is a typo error, CANES are 7 million cans. Fixed costs are 3 million a year, and a variable cost are $2 per can. The product is priced at $6 per can. Depreciation is straight line and salvage value is 0. The opportunity cost of capital is 14% and tax rate is 35%. What is the project NPV under these base case assumptions? In B part, what is NPV if variable costs turn out to be 2.20 per can? And what is NPV if fixed costs turn out to be 4.5 million per year? And at what price per jar would project NPV equals to 0. So first of all, we come to the part A, that what is the project NPV under these base case assumptions. So here one thing should be clear in your mind, that in the calculation of NPV you need at least two things. One is your initial cash outlay or initial investment or initial cash outflow, and that is given in the question, that is 12 million. And the second thing which you need to calculate the cash inflows. So here in this question you should focus that how can we calculate the cash inflows, because NPV is equals to minus cash outflow plus cash inflow multiply by PVIFA factor. And if cash inflows are similar for each period, then we can use here present value interest factor of annuity. And if cash flows are non-similar for each period, then we should use PVIF factor, present value interest factor, and should break the formula of NPV, which we already discussed in previous topics. So first of all, we come to the point that how can we calculate the cash flow. So first of all, what is your revenue? Here price multiply quantity, very simple formula to calculate the revenue. What is your sales here and what is your per unit price? Per unit price is $6 per can, and your expected sale of automobile cans are 7 million cans. So 7 million multiply by $6. So it is equals to 42 million. After the calculation of revenue, now we come to the expenses. As you know that total cost is always equals to total fixed cost plus total variable cost. And here what is your fixed cost and what is your variable cost? So here, as you are seeing here, that fixed cost are 3 million a year and variable cost are $2 per can. So 3 million is your fixed cost and variable cost, because it depends on the unit which you sell. So $2 multiplied by 7 million, that is your variable cost and that is your fixed cost. So it will become 17 million. So 17 million are your expenses related to fixed and variable cost. And one another expense is depreciation here. So depreciation, very simple formula, because straight line depreciation is adopted here. So formula to calculate the straight line depreciation is simply cost of your project minus scrap value divided by time period. So time period is here 6 years, and your initial cost is 12 million and salvage value is 0. So 12 million divided by 6 years, or 12 divided by 6 equals to 2 million per year is your depreciation. Now follow this formula, that 1 minus tax rate multiplied by revenue minus expenses plus tax rate multiplied by depreciation. This formula is already discussed in previous topics where we calculated cash flows. So what is your tax rate? Tax rate is 35%. So 1 minus 35% is 0.65 multiplied by revenue minus expenses. 42 million is your revenue and expenses are 17 million, plus tax rate 0.35 multiplied by depreciation, that is 2 million, and your cash flow is 2.8 million. Here 16.25 million plus 0.7 million equals to 16.95 million. Sorry, 16.95 million. Here there is a little mistake. So your cash flow is 16.95 million. Now we come to the calculation of NPV. Minus cash outflow plus cash inflow multiplied by PVIFA factor. Here you can use the PVIFA table at 14% interest rate and 6 years, and instead you can calculate through PIFA manual formula. So here formula is already given, a lot of time we already discussed this formula. So calculated factor is 3.88, and just put up this factor into this PVIFA 14% 6 years, and cash flow is 16.95 and initial cash outlay is 12 millions, and after calculation your NPV is 53.766 million. Now same method should be adopted in all these two cases. In B case, what is NPV? Variable cost turned out to be 2.20 per cane. So all the process is same which we adopted in the part A, but only in the case where we calculated variable cost should be changed, because in previous case variable cost was $2 per cane, but here we just change into 2.2 multiplied by 7 million, and that will become 15.4 million, and fixed cost is 3, and depreciation we already calculated that 2 million per year. So your revenue will be 42 and your cost is 18.4 million, and just same formula once again we will apply here, and in second case your NPV will become 15.2352. You can pause the video and see the calculation. And in C part there is a change, that rest of the question is same as in the base case, but only fixed cost is change from 3 million to 4.5 million. So 7 multiplied by 2 is your variable cost, and plus fixed cost is 4.5 million, and 18.5 is your expense. So cash flow 1 minus tax rate, so 42 million minus 18.5 plus tax rate 0.35 multiplied by depreciation 2 million, and your cash flow will become 15.975. 15.975 will be your cash flow. And once again we just applied NPV formula here, that minus 12 million is your initial cash outlay, plus cash inflow is 15.975 multiplied by factor PVIFA factor at 14% and 6 time period, and your result is 49.983. So that was the C part of the question. In D part, at what price per jar would project NPV equals to 0? So simply NPV formula will be applied here, and we will take NPV equals to 0, because at 0 NPV there is no profitability and there should be no loss. So NPV should be equal to 0. And revenues, because we do not know about the price, so price multiplied by quantity, price multiplied by 7 million, it will become 7p, because we do not know about the price, which we are going to explore, that what should be the price at which NPV will become 0. And expenses are variable cost plus fixed cost. In case of variable cost, it will become 7 million multiplied by 2 and 3 million as we already calculated in the base case, and that will be equal to 17 million. So cash flow is 1 minus tax rate multiplied by revenue minus expenses plus tax rate multiplied by depreciation. So 1 minus tax rate is 0.65 multiplied by revenue is 7p minus 17 million plus 0.35 multiplied by 2 million, and your cash flow will become 0.65 multiplied by 7p minus 0.65 multiplied by 17 million, so that will become 4.55p minus 11.05, and 0.35 multiplied by 2 million is equals to 0.7. So after summing this equation, cash flow will become 4.55p minus 10.35. And now we should apply here NPV formula. NPV is equals to minus cash outflow plus cash inflow multiplied by PVIFA factor. So factor is 3.88, initial cash outflow is minus 12 million, and plus cash inflow is 4.55p minus 10.35 multiplied by factor 3.88, and that will be equal to, once again here is a typo error. So here NPV minus 12 plus 17.654 p and minus 40.158 after summing this part of the equation. 4.55p multiplied by 3.88 minus 10.35 multiplied by 3.88. And here now we will take NPV equals to 0. Equals to minus 52.158 plus 17.654p, and finally your price will become 2.954. So at the rate of 2.954 you will get no profit and no loss, or you simply can say that that is the level of price at which you can get break even. So after solving this question, that is your practice problem 3, there is a little change in the data. I took this question from the book, so you just pause the video, and if you have notes or you have book of corporate finance Brealey Myers, you can take this question from there, or you can simply pause the video and just try to solve this question. After that, question number 4, if unit price is $80, variable cost is $45 per unit, fixed cost is 400,000 and expected unit sales is 38,000 units, required rate of return is 12% and tax rate is 40%, initial investment is 2 million with straight line depreciation for 10 years, having salvage value 0. What is project NPV under base case assumptions? What is NPV if only sales increase by 10%? And what is NPV if fixed cost, variable cost, expected unit of sales and unit price are declined by 30%? The method to calculate this question is same as we adopted in the previous question. So you just you can pause the video and see the whole process. Only in case B, we just take the sales increase by 10%. If sales is expected unit sales is 38,000, so we just 10% increase in this 38,000. The 10% of 38,000 is 3,800, so we just add up this 3,800 into this 38,000, and rest of the process is same as we adopted in the previous question, and you will adopt in the part A of this question. And in case C, we just reduced fixed cost, variable cost, expected unit of sales and unit price declined by 30%. So rest of the process is same as we adopted before. So you can just pause the video and solution is given here. That is the solution A, in which cash flow is 638,000 and NPV at 12% 10 years, your PVIFA factor is 5.65 and your NPV will become 1604700. And there is the solution of case B, and same you can pause the video and see the solution, in which your cash flow will become 717,800 and here your NPV will become 255570. And in case C, in which we reduced all the variables by 30%, and in this case your cash flow will become 303020 and your NPV will become minus 287937. And similarly, at the end of this question, another problem is given for your practice, which is taken by from your book Corporate Finance by Brealey Myers, and it is the practice problem number 4, in which unit price is 50, variable cost is 30, fixed cost is 300,000, expected sales is 30,000 units per year, and here some little detail is given at the end of this question. So you should try to solve this question. After that, question number 5 is related to break even. If fixed cost is 10,000, depreciation is 5,000, price is $1 per unit, and accounting break even is 30,000 units, then what must be the variable cost per unit? So first of all, you should know that profit is always equals to total revenue minus total cost, and at break even level profit is considered to be 0, So total cost is equals to fixed cost plus variable cost plus depreciation. So here your fixed cost is 10,000, depreciation is 5,000, and you don't know about the what must be variable cost per unit. Okay, so you don't know about the variable cost, and depreciation is 5,000, and total revenue is equals to price multiplied by quantity. So price is $1 per unit, and quantity you are expecting to sell is 30,000. So your revenue, total revenue will become 30,000. So now we come to the profit formula, and that is equals to total revenue minus total cost. So total revenue is 30,000 and minus total cost is equals to this 10,000, that is fixed cost plus variable cost plus 5,000, and you should use these brackets. So variable cost, you don't know about the variable cost. So at break even level, profit is also be considered to 0. So profit should be assumed here as 0. So now we open this formula, and 30,000 minus 10,000, if there is minus sign before the bracket, then all the signs should be changed. So minus variable cost minus 5,000, and after summing this equation, it will become minus 15,000 equals to minus variable cost. So minus will be eliminated through this minus sign, and your variable cost, total variable cost, will be equals to 15,000. And if you want to calculate per unit variable cost, just simply divide this variable cost by units, and units are 30,000 units, so your variable cost should be 0.5. Same at the end of this question, one another practice problem is given for you, which is taken from the book Corporate Finance, Brealey Myers. So you can pause the video and see the question and try to solve this question. In next coming videos, we will discuss about something more related to project analysis. So till then, Allah Hafiz, bye bye, take care of yourself and other persons around you. Thank you.